Aditya Narain joins us, Research Head Institutional Equities with Edelweiss Securities. What should we start with?
Your call.
No, it's confusing to see that the headlines, economic headlines, and the market print are not matching. So either headline makers like me who write the economic headline, they get it wrong, or market callers like you will get it wrong. Somebody will have to get it right, or somebody will have to get it wrong.
See, I think
we have to agree to meet.
Well, I think in life, nothing is completely black or white, right? It's somewhere in between. And to some extent, I think you will see that marrying happen, wherein you will move a little bit towards the mean, i.e. the economic headline will probably start looking a little better. The market headline will potentially start looking a little weaker. So I think there will at some level be a certain amount of convergence, but I don't think it will necessarily be very, very sharp.
Okay, so you are expecting, however, things to improve. You know, let's talk about some kind of timeline. I mean, we're watching out for the budget, of course, but even given what we've seen in terms of measures so far, easing so far, the IMF also saying it will improve going forward. What's your thought in terms of the speed of the recovery?
I think in terms of the pure speed, I would suspect is going to be relatively modest. I don't think it will be very rapid. I think in terms of drivers of that speed, I think the one thing that they have got right in the ecosystem is the amount of liquidity that's sitting in the system. The moment you have money lying around there, it does tend to seep around and find its own level. I think what is missing is effectively risk appetite, because I think most economic players, whether it is businesses large or small, have struggled with risk over the recent couple of years, and I don't think there is enough of confidence for people to go out and either spend or invest aggressively. And I think that will take a little bit of time. And to that extent, the fact that the market is doing well, is fundamentally doing well, I think that actually is a lot of support, because if you see headlines with people making money on the stock exchanges, there is a slightly feel-good factor about it. So I think that's an important element of it. So if you suddenly see the market weakening a lot, it'll potentially weigh on the actual recovery.
Interesting. So, okay, so all right. So I'm not sure which situation's better then.
See, you are in the situation you are in, which is the economy has taken a reasonable hit. It is much lower. Confidence in the system for players in the system is effectively lower. The issue is, are you ready to start getting out of it? I think at some level, what has happened is the downside shock that was there in the system over the last 12 to 18 months, that something is blowing up, XYZ is happening, numbers are looking weaker and weaker every quarter. I think that has actually bottomed out, right? So there is business as usual. You and I come back to office every morning, irrespective of what's happening. It's the same with the bulk of the country, right? And to that extent, once you've got a certain amount of stability, once you've got liquidity in the system, hopefully you'll get some demand stimulation as far as the budget is concerned. You will start seeing things come back. But I think the challenge with the market is that it's continuing to hope for a very strong cyclical recovery, and I suspect that's going to be more subdued than what the optimists are looking out for.
That's the logical way in which how things move. But now let's look at a trend which in a sense is a profound trend which is staring at us, which is that the concentration of business, wealth and profits is migrating towards large companies. Whether it is US tech or Indian Airlines, Indian hotels, NBFC, banks. Some would argue that this is a trend which is a mega trend, that large caps will get better and more. And aren't markets already betting on that? So if the economic recovery happens, it's the Bajaj Finance or Indigo or a DMart or maybe a Reliance or a Kotak Mahindra Bank will do well. And that stock markets are already rewarding or already betting on that.
See, I think the difference or the opportunity lies in terms of how much the markets are factoring in that trend to sustain. Is that trend, as you mentioned, is it global? Yes, I think Piketty argues about it, the fact that there is concentration in everything, in every space of life, whether it is money, whether it is personal wealth, whether it is businesses. The issue is how much is the market actually factoring in that change? And I think that is quite a bit. So at some level, I don't see that shift, that fundamental shift dropping off, right? But the reality is, our argument really is that the level below that absolute cream, which has not been impacted at all, is where you're going to, where you're probably going to find value in terms of equities. I think for the lower end to come up, whether it is the smallest cap businesses or whether it is, the smallest earners, for that you need a much stronger economic response. I think this argument that the valuation gap has expanded substantially, so go to the bottom, is not fully backed by the view that unless the economy shows an upsurge, you're not going to see disproportionate trickle down happening there.
So if you have to make a portfolio which has a shelf life of 3 to 5 years, would you buy the same names, assuming that whenever the economy heals and whenever the economy picks up, these existing large players will become bigger? So it could be a combination of private banks, private insurance companies, 1 or 2 NBFCs and 1 or 2 consumption names.
From a 3 to 5 year perspective, I wouldn't go that way.
Okay.
For the simple reason that I think in the nearer term, I think this huge risk aversion, I think, is going to ease off a little bit. So I'd go for the next level, which is what our call would be for the next year, year and a half. Depending on how we see the economy respond to measures that have come and are likely to come, and depending on how strong the cyclical bounce is, I think based on that, you might want to go much lower. But that will be much lower in terms of the size of businesses and in terms of the valuation levels. And I think for that to happen, I would clearly hold back for a year, year and a half to get confidence that either there is lots of momentum in the economy coming back, or I see enough happening in the economy to argue that further down the line that will come back.
So you've touched upon cyclicals a couple of times. Would that be the next big theme according to you as well, or do you just see that as one that you're observing but you're more bullish on something?
We'd actually play the global cyclicals, right? And to some extent, some of the agri spaces can really fall in the global cyclical space because that's where you're also seeing actually a response, rather than necessarily domestic cyclicals.
Okay.
Wanted to get in your view as to what you're expecting from the budget. There's a lot riding this time around. You were just talking about the overall environment, that risk appetite not prevalent, the overall liquidity that has been a bit benign. What are you expecting from the finance minister?
I think at some level, when it comes to personal taxes, I think they've got themselves in a little bit of a bind because the expectations are so high. So I think they will have to go that way, quite honestly, right? I think they've got their backs to the wall on that. It's not necessarily a bad thing. Is it enough? I don't think so. But I think it is something that will come through. I think the second thing for me, which is very important, is I think what you require is backstops for some of the challenges that you're seeing in the system, whether it is the financial sector, whether it's the airlines sector, whether it is telecoms more recently. You require some backstops saying that, hey, we are not just going to let businesses go into the ground, right? And I think it has to be more proactive, more aggressive than has been the case so far. Because if you don't have that backstop, these problems tend to linger on. So you see the NBFC issue, it has gone on and on because I think at some level there wasn't active enough intervention, I think, which is what you effectively require. If you provide that, hey, things are not going to get worse from here because this problem has been provided some support, I think the dynamics of the whole economy will start changing a lot. And that's where risk appetite will start coming through. So I'd say measures in that space, announcements in that space, I think would be very important. Very fundamentally, from the policy push perspective, in our view, last year was a year of missed policy opportunities. We should have tried to stimulate the economy more aggressively than we effectively did, right? I think to some extent the boat has moved on, but I would still say you require that. Because the longer stuff stays low, the harder will be the climb back, the slower will be the climb back. And if there is risk that needs to be taken with the fiscal or with monetary policy, I think it is now.
Okay. Where do you think there is scope for strong earnings and strong P expansion in this market? That's a potent call, right? When market re-rates your value and earnings re-rate your fundamentals.
Yeah. So I think there are two ways to look at it. And one of it is to look at the play between the balance sheet and the P&L. If you really see what's happened with the market so far, it's been very, very focused on the balance sheet. And that includes what's happened over the last couple of weeks, right? Our sense is this year you'll start seeing the turn of the market focusing on P&L issues, which is earnings issues, rather than the balance sheet. See, I think everyone's been flogging earnings for the last 3-4 years and saying, hey, earnings have not come. And that's why there's been a little bit of an issue with the markets. I think the reality is it's not been such an earnings issue. It's been about the balance sheet and it's been about risk. So the top end of the market, where a lot of value is concentrated, it's concentrated not because they've necessarily been growing rapidly. It is because their balance sheets have either not had any issues or they're in businesses that don't need to be
like Kotak Mahindra Bank. I mean, the balance sheet or the book is not in an issue, so they're commanding a price to book of 6.
But you can argue that's the same for the consumer companies also, that, hey, the risk lies with balance sheets and with leverage. If you're not in that space, you will do better, right? I think, so it's not about, it's been a combination of being valued down for bad balance sheets and being valued up for good balance sheets. I think that trade has played out, and this telecom issue, I think, was the last of them. So I think there fundamentally will be much more of a shift towards looking at earnings and P&L.
Give me an example. It's a great point. I mean, I love that point.
Yeah. So I think whether you look at telecom, where you're going to start seeing earnings come through, and the balance sheet risk, to some extent, there's some uncertainty in terms of how it will play out from here, but it's more or less captured itself. I think even with banks, I think this entire issue of balance sheet and balance sheet risk, I think that will start moderating. In fact, if you see some of the numbers that have come so far, the issue has been on growth. It's not been on asset quality so much, right? And I think this is going to be the trend that you're effectively going to see going forward. I think if you look at cyclicals like the global commodities, which is what we've actually upgraded recently, I think you're going to actually start seeing earnings come through there. So in our view, even though balance sheet is paramount in most people's recall framework, I think this is the last bit of it. This is the last swan song of the balance sheet trade. It's going to be much more of the earnings trade that comes through. A lot of the earnings you will get at this point in time will be a base effect, right? And that will be valued up a certain amount, but not as much as the headline. But I think core earnings is where I think you will start seeing more focus go through.
Okay, would you bet on the entire demographic demand play from the other angle in terms of hospitality, leisure, travel? If you look at it in that perspective, I ask in terms of A, the fact that the slowdown is still underway, and B, also just in terms of pure pricing power.
I think that's going to be more cyclical, I think, than a lot of other stuff. Okay. Because that is very discretionary expenditure, and it's not even discretionary like a house or a car which lasts beyond the meal or a holiday or a week's holiday. So I think that is at the fine end of discretionary expenditure, and I think that will be slower coming in this environment. A year down the line, it might be more pronounced. But I would argue that's the space that fundamentally has a much better growth dynamic than, say, something like cars, where I think the other issues of, whether it is the EV thing, whether it is mobility, I think those will tend to be more of an overhang. See, I think those are areas where the demographic change is actually a little bit of an overhang, because the guys who are buying cars are part of the young brigade, which potentially are thinking differently about cars.
With the shift to BS6, EVs, etc., then what's the outlook on autos?
We are actually a little cautious on autos, because it is seen as the traditional bounce back. But our sense is we need to be a little bit more cautious there. I think the nature of demand or the structural growth levels of demand, I think those have got a little disrupted in this downswing. And we don't think it will come back that rapidly.
I'm just going to refresh some graphics here, and let's look at Bata 10-year, Relaxo 10-year, Trent 10-year. Everybody talks about Bajaj Finance and Kotak Mahindra Bank in last 10 years, but I'll pick up some niche names. These are not like some $10 billion companies in terms of market cap. Trent would be 19-20,000. Bata would be nearing that kind of level, slightly above that. But look at this one. Aditya, 33x for Bata, for a company which has existed for many years now. Relaxo, all they do is that they make a simple product called Hawaii Chappal. Stock is up 21x in the decade gone by. Trent, when Amazon is killing every retailer, Trent comes from the back and gives you a 16x return. What would you bet for next couple of years, which could be called as consumption stroke niche or a new business, which right now markets think is small, could become large?
So I think it is the valuing up of basic requirements, where you're being able to brand what was effectively a commodity kind of thing, is where I think there is the maximum delta, because most of these spends are 250 rupees to 2,000 rupees. They are like a meal, right? And I think there, if you can brand yourself well, if you can be of decent utility, which most of them are effectively, right? Plus, you've got to have company dynamics. I mean, all these stories will be a massive turnaround. These are not economic stories. These are, the backdrop is the economic story or the demographic or the lifestyle switch, but they are businesses that have actually made sure that they've got back with their brands. I think the interesting thing that one can take out of this is these are all brands that have been revived or recreated.
Exactly.
Right? Creating new brands in this space has tended to be very, very difficult. These guys had the luxury of great brands, and I'm sure managers, and I don't know the specifics of these, but managers came in, revamped them in a fundamental demographic environment. That's a great demographic class and a lifestyle space to have.
What would you bet on now? I don't think Bata will be 30x in this decade, or a trend can give you.
I don't necessarily have names off the back of my head, but if you were to look at brands that have established themselves, been around, say VIP, for example, as a luggage brand, that's another classic case. That demand is there, right? You have a large market share. Can you come in and make sure that you execute well, that you are effectively efficient and build on it, right? This business of moving from, mass branding or a commodity kind of good into something that is branded and something you're proud to either wear or carry around or put on your shoulder, I think that space is going to be good. I mean, one will have to do a little bit of a search for some of these brands. But as I said, all of these are guys who have existed for a while, so they've not had to recreate new brands. See, I think the whole issue is these kinds of businesses do not have the money to create brands. And Uber has the money to create brands. Zomato has the money. It has the flow to create such brands. For the rest, it's actually much, much harder. Whereas these people are businesses which have just not have built on a legacy by turning things around. And that's where I think if you want to see the demographic dividend or the lifestyle thing coming through, that's where it's actually come through. That you can sell this now in the smallest town because the guy in the smallest town wants to wear something that he sees on TV and he recognizes.
We were talking about earlier that parallel between the US markets versus as well as ours. There is that similarity, the fact that there were only a few stocks that led the way forward, the large caps primarily, the fact that there was not support from the economic front in terms of growth, but our markets were still moving higher. We were discussing it earlier this morning. Would you describe it as maybe irrational exuberance? Do you think that this sort of steady trend will continue? And when do you see assured recovery from the broader markets, which has started?
I think quite honestly, I think if you see the whole US recovery that's happened in the last 10 years, obviously there's a tech element, so let's keep that as just global investments. But the rest of the economy, and that's why when I mentioned about the budget, I talked about instilling confidence by providing a certain amount of backstop. I think the US's greatest commitment to this was during the financial crisis, where they came in and they backed firms so that there wasn't greater disruption in the system, right? Post that, basically you had businesses tightening up very, very dramatically. They had earnings that came through, and investments came through only after 4 or 5 years. Whereas in India, what you're looking at, everyone is talking about investments, whereas actually what companies are talking about is let's, one, hedge ourselves from our balance sheet risks. Secondly, let's get more profitable, right? And it's only later that you will have the broader demand expansion. So India today is not that different from the US in 2010 or 2011, where there was a problem, you'd got a certain amount of backstop, and you had a market economic disconnect. This big disconnect that we talk about, the economy is going down and the market is going up. It happened in the US 8 or 10 years ago, right? But it effectively played itself out because if you had the markets come through, which reflected corporate profitability, it ended up in investments and job creation. But there is a lag. And I think we are trying to put the cart before the horse in saying, when's the economic recovery going to come through, right? You need to have corporate confidence, corporate recovery, and then that cycle plays through.
Lovely having you with us in our studios, Aditya. Thank you so much for taking time out and joining us.
Thanks so much.